Hi there, folks. It's James Marley here, and welcome to The Rules of Investing. I'm joined today by Steve Johnson, who's the Chief Investment Officer and founder of Forager Funds Management. Steve was the managing editor of the Intelligent Investor investment newsletter business for over a decade before spinning out the funds management business to start Forager back in 2014. Now, Steve's roots are in Australian small caps, but today Forager has grown, and over the years it has added global equities to its suite or its portfolio of expertise. Today we're going to be getting a download on the latest ASX reporting season, which has been a really interesting one. We're going to talk about some of the small cap opportunities that Steve and the team have identified, and we'll also touch on a provocative topic: the need for active managers to adapt or die. Now, if you're an Apple Podcast or Spotify user, don't forget to subscribe to the podcast so that you don't miss an episode. Or if you're a Livewire subscriber, hit the follow button at the bottom of the wire to be notified when new episodes are available. And if you're not a Livewire subscriber yet, just head on over to livewiremarkets.com. It's free, easy to register, and you'll get access to insights from the leading investment minds in the country. With that, let's get into the episode. Steve, great to have you in. Thanks for stopping by.
James, thanks for having me on. It's great to be back.
A little bit of nostalgia for me when I look at the timeline. I met you way back before Livewire even existed. You were at Intelligent Investor, and you were one of the people that we showed the original idea for the business to way back in the days, and I obviously followed your journey to Forager, so a bit of a trip back through time.
It's amazing seeing what it's become too, James. I think it's quite different from what you started out thinking it was going to be, and that's been a great journey to watch unfold. And also, I think just from a business perspective as well, seeing you adapt, and it's true of most businesses. I think if you want to be successful, it's very rarely the first business plan that you start with that is the one that works.
And they continue to change. I mean, that would be true of yourself. What's it been like moving from those newsletter days to running a funds management business today?
It's been a lot more of a challenge than I thought when I first started, that's for sure. And I would say that whole journey for me, I was 25 when we bought Intelligent Investor. I was young. I was 30 when we started the funds management business. That was young. There's been a lot of lessons that the clients have had to sort of pay for along the way, if that makes any sense, in terms of me learning to run and to grow a business. So it hasn't been that different in funds management. That I thought it was going to be a whole heap simpler, but to be honest with you, it's been a lot of the same challenges around people and retention and incentives and getting your philosophy and your structure right. It's been as much of a challenge as it was running the newsletter business.
Yep. One more question before we dive into reporting season. How different is it running a fund to writing a newsletter and writing to a subscriber base about stocks and the stocks that you like?
Yeah, fundamentally different, I would say. And the big thing, I've said a lot about this lately, but for me, funds management is more than half about portfolio management. Having the right weighting in the right stock at the right time is as important, if not more important, than just picking the right stocks to start with. And that's been the massive journey for me as a leader of the organisation and as an investor is, yes, you've got to look in the right place and you've got to find the right ideas, but you've also got to get that portfolio management piece right. And as we've got bigger, that's become increasingly important.
Now, we'll talk about that in a little bit more detail further on in the podcast, but let's get into reporting season, because it's, to my memory, I reckon it's been one of the more interesting reporting seasons that we had for a while, with a lot of, we've had M&A interest from offshore, we've had some founder flameouts, we've had a couple of stocks running hard, a bit of an inflection point for the banks. So, what would you say the main observations that you've got from this reporting season, noting that it's not quite finished yet, and what did you like, what haven't you liked?
Yeah, I'd say over the last 10 years that we've been doing global equities in the US, reporting season has been getting more and more volatile. So company reports results that beat expectations by 2% and the share price is up 15 or 20%. If it misses by the same, it's down 15 or 20%. And I feel like that's coming here. It's been a really volatile reporting season in terms of share prices, and certainly across my portfolio, both on the winners side and the losers side, I don't feel like the results have been as volatile as the share price reactions. So I think that's a feature that's come here. It's probably driven by a lot of the algorithmic trading. There's a lot of systems out there that just immediately trade on the directional nature of the news and are moving share prices a long way. And then it's been stocks that previously had very high expectations and hopes about them that have done most of the damage in terms of the big downside moves. And I have felt like that was coming for a long time. It was a really small part of the market that was very popular, trading at very high prices, and there's been quite a few of those stocks come unstuck. And it's not necessarily, again, horrible results, although you'd argue a Johns Lyng probably was a horrible result, but a lot of those companies were trading at nosebleed valuations, and that's been where the problems have been. And I think on the other side of things, it hasn't been great results, but it's been low expectations around some of the stocks that have done really well. When I look across our portfolio, and Nanosonics had halved over the 12 months prior to its result coming out. Peoplein's a good example of a share price down 80% over the past couple of years, and the business is going okay.
Yeah.
Not great, but okay, and the share price is up quite a bit over the past week or so since the result, and I think that's been a pretty consistent theme.
Yeah. I know you're not a thematic kind of person, but in terms of general observations, you listen to a lot of earning calls, you're speaking with management. Are there any things that when you will reflect on February 2025 and say, these were a couple of the consistent messages that are worth hanging on to?
I don't feel like it's getting worse out there, has been the general message from people that are pretty economically exposed. So I think there's a general feeling that it's at least bottomed out economically. And then I still think you're seeing a lot of post-COVID adjustments to margins, and businesses that were over-earning through that COVID period still suffering from a reversion to what they were doing prior to COVID. Maybe the auto dealerships are a really good example of that. They had an incredibly profitable time through COVID, and the unwind has just taken a long time. And we're still seeing quite a bit of noise about that in our portfolio. In the tourism space, for example, it's still not back to what it was pre-COVID. And a lot of companies still dealing with wage inflation. And you're seeing a lot of our sales are up 2 or 3%, but it's nowhere near enough to offset the fact that our costs are up 5 and 6%. So you're seeing headline inflation come down, but a lot of companies, and I guess that's reflective of these are results from last year.
Yeah.
They're still dealing with, 2024's costs were a lot higher than 2023's.
Yeah. You're a small cap lover, tragic investor. And, data that looks at professional investors in that small cap space shows that it's actually a part of the market where active management can outperform on a pretty consistent basis. What is it about small caps that makes it such a fertile hunting ground, and why do you like it?
Well, the volatility first creates opportunities. You go to university and they teach you that volatility is risk, but I think if you're looking for opportunities, the more volatility that there is in a particular space, the more chance that you're going to get to buy something at a really cheap price. That's number one. I think the competition is less, and it's probably the most important. There's a lot of people playing a different game in the stock market, right? There's analysts working for big banks that are trying to get the next quarter or the next 6 months right, and a lot of their clients are hedge funds trying to do the same thing. So there's a lot of people playing a different game, and sometimes at the larger end of the market with a longer time horizon, you can still find attractive investments. But generally, you've got a bunch of very, very smart people that know a company inside out that are looking at the same things that you're looking at. That in small caps is nowhere near as prevalent. So you've got the opportunity to out-research people, to find things that other people are not aware of about a business, and also to get access to companies, particularly I think in the professional funds management side of things, our access to those small company management teams is very good, and that can be a negative sometimes as well. But generally, I would
because
say,
you get too close to them, or you create a bias.
Generally, I'd say it helps, but it can cause problems when you believe too much of what people tell you. But I think again, it's just a space where you can add a lot of value at the small cap end because you know something about this company that is not reflected in the price. That's pretty uncommon at the large end. So, like you said, you've seen the median, you get on Morningstar and look up small and mid-cap managers in Australia, and the median manager has actually outperformed the small cap index quite significantly, and that's what we're aiming to do over the long term. And I think it's almost exclusively in that part of the market where you're seeing that consistent benefit of active.
Yeah. The dream in small caps is to find that overlooked gem, something that can grow and explode and say potentially get up into that top 200, top 100 companies. You've got a couple of high flyers in the portfolio at the moment that have done spectacularly well. Maybe you can talk us through sort of the thesis on some of those top 5 positions that you've got that have had a really strong runs.
Yeah, I'm no futurist, and I think you find a lot in the small cap end of the market. People are trying to predict a trend that nobody is aware of or has seen, or this is going to be artificial intelligence or whatever the latest buzzword is. There are people that do a good job of finding companies that are going to benefit from those trends. That's not what we do. I like a good long track record. I like buying businesses on audited financial statements where I've got data, and we're generally playing the sentiment roller coaster rather than trying to predict the future. And some of our, let's take Catapult for an example. That's been a wonderful success story for us over the past 12 months. That share price today is lower than it was in 2016. The company traded at 14 or 15 times revenue back in 2016 when it first came to the ASX and was a real darling stock. And our whole approach is not to completely ignore those businesses. What is it that people are excited about? I run through a park outside the Sydney Football Stadium and cricket ground in Sydney most mornings, and I would see all of these teams using Catapult's player monitoring equipment all of the time. They've got all the stuff set up on the outside. I'd sit there and say, okay, people are excited about this business and it's a real product and it's interesting. I go and look at the financials and say, I just can't make that stack up from a valuation perspective, but the seed is planted. This is an interesting business. I can see why it could grow. And then we wait for the sentiment to get negative, and it doesn't need to be the case in every stock, but it happens often enough that these things go through the sentiment cycle that at the bottom of the cycle, we sit there and go, well, there's actually something right about what people were thinking at the top. This is a product that's got a lot of demand for it. It is a company that has grown for a long period of time. Now everyone's upset about the fact that it's not making any money. That is a legitimate concern, but here we are at a share price that is 80 cents, not $4, and now we're getting an interesting risk-reward trade-off here around taking on some of that risk. So, in that case, it was a new management team. They actually laid out a pretty clear plan for here's how we're going to translate this revenue growth into profit growth. We needed to get some evidence that was going to be the case, but we've made all of our money there from buying what we thought was a good growth stock, but at a point of maximum pessimism. And that's almost exclusively the case for us. I talked about Nanosonics a while ago. That share price was $10 down to $3 when we were buying it. Breville was $4, trading at 40 cents a year ago. They are what we identified was a good business at the core of it, but usually they're going through some issues that have caused the sentiment in them to plummet, and that's more our game than trying to predict the future.
Yeah. There's two things you've said there, which I guess one I knew about you, which is you've got a stomach for a good grasp of your emotions when it comes to inflection points where there's a lot of pain and noise around a stock or pessimism. But the thing that surprised me then is you're talking about buying a stock that's not profitable, which I guess I always felt from those intelligent investor days, you were always looking for companies that were generating cash and potentially paying dividends. And that is that a change for you over time?
Not really, no. I think even back in the intelligent investor days, Jumbo Interactive is probably a good example of a stock that wasn't profitable at the time. Wasn't profitable from an accounting perspective at the time that we bought it. Even the stock that most people in that time would know me for, the old Rams Home Loans, I had a very clear model for how profitable it was going to be in a pretty short period of time. But if you looked at its financial statements at that point in time, it was losing money, quite significant amounts of it. So I'd say I've always recognised that identifying changes in earnings is more important than just buying earnings on a low multiple. There's not a lot of insight in that, right? And generally, in most market environments, if something's just trading on a low PE, there's a good reason for it. It's trying to identify situations where, okay, in 4 or 5 years' time, this P&L, this balance sheet, this business is, I want it to look more obvious to people down the track. Like, it's not like it's going to stay hidden forever. Yeah. But I want to identify something that other people aren't seeing. And most of these companies are that. And if we sat down and went through the details, I'd say to you, here is why I'm very confident that in 3 years' time, we're trading on 25 times earnings for Catapult, and it's still growing at 20% per annum. We've got that model laid out for profitability. It's not, we don't know how it's going to happen, but I've always had a focus on trying to identify things that were wrong. Even the infrastructure stocks, which was a really fertile ground for me for a long period of time. I remember people saying, well, this Sydney airport's on a PE of 50, right? And what was the opportunity there? Well, they were depreciating the whole value of the airport, which they were never, ever going to have to replace. And you were seeing accounting earnings that were really low, but your cash flow was really high because you weren't spending much CapEx. So again, it's okay, the accounting standards here are giving you a different picture from what I think is economic reality.
Yeah. So those two companies you mentioned, Bravura and Catapult, Bravura and Catapult, they sit in your top five. You've talked about the good run they've had. Do they stay in the top five? They're starting to, the market caps are getting up there towards the top end of the range that sits within your portfolio. What's the, you've talked about a bit of a forward picture for Catapult. Could you maybe give us an update on the thesis from here?
Yeah, I mean, it is all dependent on price. If the price goes up too much and we don't think the future returns are there, we will sell the stock. That's not normally for us, though, a point in time. Today we're selling it. It's okay, well, the price has gone up. The risk reward is worse than it was. We now have 9.5% of our portfolio in Catapult. That becomes 8, becomes 7, becomes 5 as that equation changes over time. So it's not a point in time. I still think that business has a lot of growth ahead of it. I think we're at a point where there's a lot of people like us have made a lot of money over the past 2 years. The share price has run up. You're always going to get a digestion period while that happens. But if they keep delivering the results I think they're going to deliver, it still looks very attractive to me. And there's not a lot of companies on the ASX that have got that sort of global growth outlook ahead of them and still trade at what I think is a pretty sensible price. So that one is still a very big weighting for us. Bravura is still an important investment for us as well. It's a bit of a different story though, because the revenue growth there is yet to arrive. It has been a complete cost story. Mm-hmm. They have taken out 30% of the cost base there, and it's gone from loss making to profitable. So I think for that to continue with good appreciation from here, you're going to need to see revenue growth at some point, and that piece of the puzzle's less clear cut for me, but it's still an important investment for us.
Now, Steve, there are a couple of names where you've been early into them. They've done well. What about a company that's made that transition from being small, continue to grow, that you've overlooked?
Yeah, it's been a very fruitful part of the ASX, and it's because the optimism about the things that are ticking the boxes is so wildly different from the pessimism about the things that are not, that if you can bridge that gap and go from not popular to popular, the uplift in prices is very substantial. I think the most obvious one for us is Generation Development. We've done the work. Alex Chevrolet, who works with me on the Australian Fund, had done all of the work on that stock and written it up, and we're maybe a bit greedy on price, but it was, again, a stock. So it owned Lonsec, that business, and that was sort of the secret part of the puzzle there, that there was quite a high quality part of the business there that was being hidden by a fairly complicated sort of financial services business. They had the right to buy the rest of Lonsec, which they've recently done. Lonsec's got a SMA business that's growing very quickly. So the business sentiment has changed dramatically, and Alex had identified that, and we were a bit greedy on price, and there's been quite a few of those over the past sort of 12 to 18 months. As long as the things we're doing are working, then you can live with that. I'd rather we're making mistakes on missing out on things than making mistakes on the things that we do. Yeah. But yeah, there's been a bit at that sort of smaller end of the market that's done really well, that was in our sweet spot, and that's the bit that's frustrating about it.
Yep. In a case, say, take Generation Development, for example, where the story has changed quite substantially in a short period of time, do you have to go back and redo it? Like, even at this point in time, they've done a capital raising, they've acquired another business. The picture's changed quite dramatically. Does it warrant a revisit of the thesis?
Definitely. And I would say It's not something that we're getting perfect, but it's something that we've changed dramatically over the past 5 years, is being willing to pay more for something where the story has changed for the better. I think as a value investor, as soon as the share price is up, you've got this longing for, I could have bought it at this price. And we've worked really hard to try and just put that in the rearview mirror and say, what is the opportunity that's in front of us today? And this is on stocks that we already own. You know, all of those companies that we talked about before, we upped the weighting of those significantly after the price had gone up because we were getting evidence that the thesis was right. And to your point about generation development, it was probably an opportunity to do the same from a starting point of not even owning the stock for us. That's probably the last little piece of the philosophical move for us. We're doing it really well on the stocks that we own, but even on the stocks that we don't own is to a genuinely independent. I'm going to start from scratch here. I'm going to forget that the share price was 20 or 30% lower a few months ago and run the numbers on this. And I think in that particular case, conscious of the fact that this is going to become bigger, more liquid, going into indexes, the required rate of return here is lower than it might be on, or than it was on that same stock even 6 months before when it was tiny and illiquid.
Yeah. Yeah, so they're mitigating factors in the picture for a company if they're likely to be more liquid and they're on that trajectory into the index inclusion.
Yeah, so we've got this scale for what this has been something that's worked really well for us over the past few years. But when I first started the business, I wanted to do 15% per annum. I thought that's what is the right sort of number for people to invest in small caps and us as active managers. And therefore, every stock that I bought, I said, well, I want to make a case here for how this stock is going to deliver me 15% per annum. And we have changed that to be a spectrum of returns. And at one end of that spectrum is 12% is a really good return for a very low risk business with lots of liquidity, good balance sheet, low operational variability. And at the other end of the spectrum, we want more than 20 to invest in a business with a shorter history, for example, lower liquidity, more operational variability. And the stock itself can move down that scale. As it gets bigger and it gets more liquid and it fixes its own balance sheet, then we can hold it from when it was bought as a 20% opportunity to, okay, we can hold this at 12 as it graduates. And that's letting us make a lot more upside from those companies. And it lets us buy the lower quality businesses as well. You know, we've done well out of mining services over the past year. We own a company called Peoplein that I think is going to do very well for us over the next few years. They're not the greatest quality businesses, but sometimes they trade at prices that give you 20% per annum from just owning the stock. And they have a place in our portfolio as well because they meet that framework of required rates of return. It's never going to be a 12, so we don't want to hold it for the same period of time, but there is a framework there that allows us to buy those different types of businesses. Yeah.
What won't you touch at the moment? What are the small caps that you just think are kind of destined to stay that way, can't make that transition? Are the common traits, or is it again case by case? Because that's, I guess, the flip side to the opportunity in small caps is it is fraught with danger.
Yeah, sure. Look, I don't do anything that's pre-revenue, doesn't have a history. I want financial statements. I want to base my analysis off something that is real and tangible rather than a promise about the future. So there's, speculative mining, exploration, pre-revenue biotech. There's quite a bit. If you do it by number of stocks, there are a lot of companies listed on the ASX that are not generating any revenue at all. So that rules out a lot for us. And then I think the outside of that, I'd say the big change has not been ruling stocks out, but just widening the gap between what we demand to buy a lower quality business and a higher quality business. Yeah. I used to 8-9 times earnings, what a bargain. You can buy these lower quality businesses on 3 and 4 times earnings at the right point in the cycle, and we wait for them to get there and we sell them at 7 and 8. And in mining services, for example, that has been working very well for us to just recognise what the business is and that the right price for it is a lot lower than for a better quality company.
Yeah. Maybe we can dive into some specifics. As I said, we talked about a couple of the high flyers in the portfolio. What's a new opportunity, one that hasn't had its moment in the sun just yet?
Look, I think that Peoplein is a really interesting business. It's tiny, low liquidity, so it's not one for people to be, piling into. But I think that business, it's not as bad as people.
Could you
think
maybe
it is.
explain
So this is
what it
a
does?
labour hire and recruitment business. So they have a part of their business that gets placement fees for finding full-time employees for people. That 2023 coming out of COVID was the best that business has ever looked. It was making an absolute bucket load of money, not just here in Australia, globally. Placement business has evaporated, so its contribution to the earnings has gone from more than half to almost zero. The other side of the business is labour hire. They have a very stable business doing some of the Pacific Islands work here in Australia, working in abattoirs. It's a much more predictable, reliable business, and it's been doing fine. It's had its cyclical downturn as well because the health sector, everyone's probably aware of the issues that the hospital operators are going through. That's put a lot of pressure on the health side of their business, but that part of it is pretty predictable and reliable. It's leveled out in terms of its profitability. This business is probably going to make between $15 and $20 million of cash flow this year, and it's a $90 million market cap. So it's also got the capacity. I don't think it's ever going to be a darling, but they were doing little acquisitions. I think if they can get back to doing some tuck-in acquisitions, paint a growth story here, it's got the potential to be more widely owned than it is at the moment. I think that part of the market is interesting. I think Nanosonics is one that we unfortunately didn't have enough exposure to through this reporting season, but that was a complete darling stock that is going through a resurrection in terms of enthusiasm towards it. They do disinfecting of hospital equipment is the best way to think of it. They sell the piece of equipment up front, and then there's a consumables component of it, which is growing very nicely. That whole health space is on the nose, so I think there's quite a few opportunities to be looking at out there in the healthcare sector as well. Yep. And then we've got a pretty long list of businesses that I would say we're keeping our weighting small until we get a bit more evidence, but they have the capacity to be much larger weightings in our portfolio if we get that. We own Tyro and Cuscal in the payment space here in Australia. We've got government reviews and RBA reviews. There's a lot of uncertainty around what the future revenue model is going to look like there, but a lot of pessimism about the sector. So we've got some investments there that have the capacity to be larger if we get evidence that we're right.
It's interesting, in that space, Zip was a darling, and then it got written off, and it's been a comeback story.
Massive comeback story, that one. And another one that we missed is probably a simple way of putting it.
Yeah. Steve, we're going to change tack here just a little bit. You wrote a piece for our Outlook series effectively saying that the active management industry needed to adapt or die. We've seen a big uptake in ETFs. We've seen it has been hard for a lot of active managers to beat their benchmark, which is putting pressure on their businesses. What do you think the future of active management needs to look like or should look like, and the role of it?
Yeah, it's fascinating watching a sector where we spend our lives analysing other people's industries and looking for competitive threats and generally doing a pretty good job of identifying those threats and factoring it into the prices that we're willing to pay for businesses. You look at all of the talk around traditional media and Netflix and streaming and the damage that they're doing, and all of those businesses trade at appropriately low prices because of the threats that they're facing.
Yeah.
What I've seen is it's a lot harder to do that when it's your own livelihood in your own business that's under threat. But I think that's what we're facing in the active funds management industry. This trend towards low-cost products is not going away, and it's a great thing for investors, in my opinion. There's a lot of cost saving here, and largely the pre-fee outcomes are going to be the same in large parts of the market. You pay lower fees, you end up with more money for yourself. And I'm a big supporter with my client base of using those low-cost options where it makes sense. So I think for the active management industry, recognising that this trend is just going to continue, and then you say, well, where are the areas where we think we can still add value. And I think one of the challenges for me, I think that's pretty obvious, that it stay small, but staying small doesn't gel with building big businesses and businesses that create enormous amounts of wealth for people. So I think that the space to stay in is to stay small. Or I think the other thing that people can think about and do is a version of index investing that's maybe a little bit more expensive, but also just comes with some rails and some safeguards to say, you know what, we're actually just trying to give you large blue chip exposure here, but we're going to try and avoid CBA when it's trading at a crazy price. I think if you're going to do that, though, it needs to be 0.2%, not 1% for providing that role, because you're probably not going to overcome the fee hurdle of a higher rate of fees. So, for us, it sort of suits the lifestyle that I want to lead anyway. As you touched on earlier, I just love the smaller end of the market, but I think staying able to invest at that smaller end of the market where there's less competition and there's good evidence for active management, I think it's crucial if you want to build a successful active funds management business.
Yeah. Now, we've talked about Australian small caps, but you, as I mentioned in the introduction, have a global fund, and there's a stock in your global fund called Wise, which if the audience was to look on the Apple, the App Store, and have a look at the top finance apps in Australia, this one was number 1 or number 2 last time I checked. It's listed in the UK, popular in Australia. What's with this company, and why do you own it, and why is it ranking so highly in Australia?
Yeah, we've been following the company for a long time. I mean, it listed in 2020 or maybe early 2021. It was basically a quick around the office. I'm using that. Yeah, I'm using it too, independently of each other. A lot of us spend quite a bit of time overseas, and we're all already using the Wise app, and that was the trigger.
Just explain to people it's a
money transfer app, which there are a lot of. So, most people will hear that and say, well, what's different about it from a currency fair, which I used to use currency fair prior. It is the full suite of FX capability, though, for retail consumers. So I have a bank account I set up with Wise here in Australia. I have a UK bank account, I have a US bank account, I have a Japanese bank account. I go on holidays with my brother-in-law and his family, and we book the accommodation, and they need to give me some money. They just do a bank transfer into a pound bank account. I can move that with Wise back into Aussie dollars. It is all just extremely, extremely user-friendly. Anyone that's used the product says this app just works wonderfully. I've got a credit card that I can use anywhere in the world, and I'm paying, it depends what currency you're in, but their average take rate is 55 basis points, so 0.55%. If I'm using my ANZ credit card, I'm paying 4%.
Wow. When
you add up the FX and the other fees, I'm paying 4%. So it's dramatically cheaper. It's easier for me to use. It's just a wonderful product as a user. And then as a business, the thing that really attracted us was if you go and look at their most recent results presentation, they say our earnings were X and our underlying earnings were about 60% of X lower. And what they're doing is not there's anything wrong with the earnings that they're reporting or any one-offs in it, but their whole business model is to keep giving back their growth to customers in the form of lower costs. So as we grow, we get more efficiencies, we're going to pass that back to the customers. And they're basically saying at the moment, we're making more money than we want to be making. We want to be giving more of that back to our customers. And that model, the flywheel model of lower cost, better product, more customers, lower cost, better product, more customers, is probably the most powerful competitive advantage that exists. You think of Cuscal, JB Hi-Fi here in Australia. They've got their cost of doing business down to 12% of their sales now. That's one of the lowest in the world. So they're big, they buy more electronics, they drive the prices down on that, then they pass it on to the customers, and then that attracts more revenue, which they can use it. So it's a wonderful model. It's one that Wise has been using. The price was full of optimism about that straight after the IPO and for quite a long time after. And over the past 12 months, a bit of pessimism started creeping into it. People are were very worried about interest rates going back down to zero. So a lot of that excess profit they're making at the moment is interest on people's cash that they're holding.
Mm-hmm.
It is going to go down, but the share price reaction was extreme. So we got lucky there just in terms of price, that the price came back to a really attractive level. And Gareth, the portfolio manager, had loved the stock for a long time. So it was an investment in August of September last year, and the price has run up a lot since. It's made life more difficult, but it's a business that we'd like to own for a really long time.
Yeah, interesting. Well, that brings us to the end of kind of the main part of the interview, but we have 3 regular questions that feature on every episode of the Rules of Investing. So if we could dive into that, we might whip through these. In the first one, we give people the option to talk about a big win or a big loss. Knowing your love for owning your mistakes, Steve, I was kind of anticipating you'd take a loss, but you can take a win or a loss. Tell us the story, big win, big loss. What happened and what did you learn?
Maybe we've talked a lot about some of the winners today, so I think we can focus on a loss here. And the reason that I'm really interested in talking about it is because I said when I walked in today, our business is in the best place it's ever been. It's been 15 years now since we started the funds management company, and we're in a really good place, both the funds with the stocks that they hold and the philosophy and the culture of the people inside the organisation. And that is a result of some of the mistakes that we've made over the years, and I think a culture of really trying to learn from them. And the stock that we had a complete wipeout on our Australian fund is Freedom Insurance. And I went back and read the research that I wrote prior to us buying that stock. And it's always easy in hindsight. They got caught up in the Royal Commission into finance. They were selling life insurance. They were actually making less profit out of it than most other companies make out of it, but their sales tactics were shown to be quite horrendous. And basically the whole business after the Royal Commission went out backwards, and it was a zero. And I went back and read the research and I said, you know what, this is not the worst piece of research here. We had a case for how that business was going to grow and how much profit it was going to make. What we got wrong was getting the weighting in that stock way too high at that particular point in that business's life. It was pretty early days on the stock exchange. It was pretty early days for the company. And we had a big weighting, and as the price fell, we just added to that weighting. And one of the big things for us out of that is small weightings, particularly in unproven business models. We've got a thesis here, share price is beaten up, but let's minimize the risk here at the start, and as we get the evidence, really upsize the investment. So that one was a big wipeout for us, and frankly, it's taken us 5 years of really good returns to. It wasn't just that stock. We had a couple of mistakes in 2018-19, and getting the portfolio weighting wrong meant it took us 5 years to rebuild the performance record after that. And that's been the big lesson for me is, again, back to what we said right at the start, it's all about portfolio management and getting your weightings right. And that stock, Freedom Insurance, was a big lesson in the cost of getting it wrong.
Yeah, it sounds like you've built that into the process now.
Very, very much so. And the flip side of it, and it's hard for a value investor, but like I said, is that capacity to add to the ones that are going well. We've made so much more money. Gentrack was another wonderful investment for us over the past few years, but we didn't make as much as we should out of a stock that went up 5-fold because it went up and we sold some stock,
right?
Or we just watched it. And as we got evidence around how well that business was going, we could have bought it after it doubled and tripled our money from that point in time. So, really aggressively upping some of those weightings is the other side of being patient while you wait for evidence that your contrarian thesis is right.
Yeah. Steve, what do you think investors are getting wrong about markets today?
US exceptionalism in our international portfolio is a really interesting one. And it's an example of a theme that's got some truth to it. We recorded a podcast, Harvey Magotti, our portfolio manager, and I 18 months ago about why we love investing in the US, the general skill set of management, the willingness of boards to actually realise value. It's just higher over there than it is anywhere else. But the flows and the sentiment towards that part of the world have become extreme, and the valuations have become extreme. So I think you'll do better out of other parts of the world than you do out of the US over the next 10 years, simply because the starting valuations are far too high.
That is a contrarian view.
It is.
Yeah, very good. Alrighty. If markets were to close for 5 years and you could only own shares in one company, what would it be and why?
I don't know how long it was ago that we did this last time, James, but I said Alphabet, I think.
I have to pull up your
Must
record
be
on that.
5 years ago, I'd say, and I was trying to think this morning of something else that I could say, but I probably wouldn't change my mind. And it's an interesting, I think, point in that business's life where it's probably facing more competitive threats than I would have anticipated 5 years ago with
AI.
Alphabet's the owner of Google, and you've got AI coming along, but I still think it is an incredibly strong business that is as well placed to take advantage of AI as anyone else. I think what's really interesting, you've seen Grok from Twitter, now X, coming out with a AI engine that people are saying is better than OpenAI's ChatGPT. Google's is also very, very good. I think data is going to become incredibly important here as these models get better and better, and if you're Alphabet, you have more data at your disposal than absolutely anyone else. And I just think about Android and Maps and YouTube, and they have their fingers in so many growing pies that if it would be a complete management stuff up if they make a mess of this opportunity that's in front of them. They're better placed than any company in the world. So it's a business that I'm very confident will still be dominant in 5 years' time, and the price is not stupid.
Yeah, it's interesting. I mean, I saw this incredible stat that YouTube is now the #1 streaming service in the the United States. YouTube's ahead of Netflix, which you would never have thought. It's just incredible.
And interestingly, when I watch the kids, they're using it in a very different way from how I even still today use YouTube. It is more of a subscription model for them than I use it as a search model. I want to find something, I go looking for it, but they will literally have it set up so that they sit down and auto play the latest shows of whatever they want to watch.
Yeah, great. Well, Steve, it's always great to catch up, but I feel like it's been a while since we've sat down and had a good long chat. So really appreciate you coming in today. I'm glad to hear that you're happy with where the business is at. And for your investors, long may the good returns continue.
Thanks, James. Appreciate it.
Well, ladies and gentlemen, I hope you enjoyed that episode of The Rules of Investing with Steve Johnson. Remember, if you enjoyed the show, why not leave a review, give us a comment, let us know what you think. It helps us improve the show and also helps other listeners find it. Thanks very much for listening.